Have you seen what's happening with Lloyds Banking Group's share price in 2025? The numbers are finally moving, and not just a little. The Lloyds share price has started to surprise analysts, investors, and everyday traders across the UK. But the big question is Lloyds finally making its comeback? Or is this just another false rally before a dip? Let's break it all down in this quick, data-packed update, because the Lloyds share story in 2025 is way more interesting than it looks on the surface. Back in early 2024, Lloyds shares were sitting around 43 to 46 pence, and many investors had written the bank off as one of those slow movers in the FTSE 100. It wasn't that Lloyds was doing terribly, but rather it wasn't growing fast enough to keep up with the rest of the market. Fast forward to October 2025, and Lloyds Banking Group's share price is now trading around 82 to 84 pence, marking nearly a 35 to 40% jump within a year and a half. That's not small change. For a bank as massive and old as Lloyds, such a move is a big deal, and it's catching attention from investors worldwide. So what changed? First off, let's talk numbers and fundamentals. Lloyds Banking Group is still one of the largest retail banks in the UK, serving over 25 million customers, and it holds around a fifth of all UK mortgages. That means its profits are directly tied to interest rates, housing demand, and consumer credit health. Now, as we entered 2025, the Bank of England began slowly cutting interest rates after a long period of inflation control. Lower rates normally mean banks earn less on lending spreads, but here's the twist. For Lloyds, it actually created a strong rebound effect. Why? Because lower rates boosted mortgage demand, reduced default risks, and reactivated parts of the UK housing market that had been frozen for nearly 2 years. So while the headlines screamed, "Rate cuts hurt banks," Lloyds quietly started to gain momentum through loan growth and improving consumer confidence. Let's look at the financials. In its mid-2025 earnings report, Lloyds reported a pre-tax profit of $4.6 billion, up from $3.8 billion the year before. The bank's net interest margin, which measures how much profit it earns from loans versus deposits, stayed strong at 2.9%, which is impressive given the changing rate environment. And get this, Lloyds also boosted its dividend payout to around 2.76 pence per share, giving investors a dividend yield near 4.8%. That's one of the most attractive yields in the UK banking sector, especially for long-term income investors. But not everything is perfect. In early 2025, Lloyds had to set aside billions of pounds to cover potential costs related to a motor finance mis-selling scandal, an issue that's still under investigation. Essentially, regulators claim Lloyds and other banks may have overcharged customers on car loans, and refunds could cost the sector over $10 billion. That's a huge risk. But what investors are focusing on right now is how Lloyds' core business, retail banking, mortgages, and credit, remains strong despite these headwinds. Another big factor driving the share price is market psychology. For years, Lloyds was seen as the boring, low-growth bank. But in 2025, value investors are hunting for stability, and Lloyds suddenly looks like a safe, undervalued dividend stock. Analysts at major UK brokerages like Barclays, HSBC, and AJ Bell have all raised their price targets, some predicting the share could hit 95 pence to 105 by mid-2026. Why such optimism? Because Lloyds' balance sheet is now much leaner, with a common equity tier ratio above 14%, meaning it has strong capital reserves. Its cost-to-income ratio is improving as digital banking takes over, and its bad loans are lower than expected. In simple words, Lloyds is healthier than it's been in years. Let's add another layer: macro trends. The UK economy in 2025 is finally showing signs of stabilization after inflation shocks and energy price spikes. The pound sterling is stronger, unemployment has eased, and consumer credit spending is up. For banks like Lloyds, this macro tailwind means more lending, fewer defaults, and better margins, a perfect recipe for stock growth. But before you rush to buy Lloyds shares, there's a twist. Despite all the progress, Lloyds still faces real risks in 2025. Regulatory pressure from the Financial Conduct Authority over the motor finance issue could drag profits lower. Competition from challenger banks like Monzo, Starling, and Revolut keeps rising, eating into Lloyd's younger customer base. And lastly, if the Bank of England surprises with another rate hike, it could hit mortgage affordability again, cooling off the market. So while Lloyd's is making a comeback, it's still walking a fine line between growth and risk. Let's talk investor sentiment. Retail investors on UK investing forums and Reddit groups are buzzing again about Lloyd's, calling it the sleeping giant of the FTSE 100. Many traders see this as a classic undervalued recovery play, while some short-term investors expect a small pullback before the next leg up. Technical charts also show strong support around 78 to 80 pence, and analysts believe if it breaks above 85p, we could see momentum carry it closer to 90p plus quickly. In other words, this isn't just random hype. The numbers, fundamentals, and sentiment are finally aligned. Now let's step back for a second. If you invested $1,000 in Lloyd's shares at 40p in early 2024, your investment would now be worth over $2,000 in 2025. Not bad for a bank once considered stuck. Add in the dividends, and you'd be sitting on a solid 55% plus total return in under 2 years. That's the power of catching a value stock before the crowd wakes up. However, experts caution, don't chase hype blindly. Lloyd still trades at a relatively low price-to-earnings ratio of around 7.5, but that's only attractive if profits keep growing and the scandal costs stay under control. If regulators impose heavy penalties or if UK economic growth slows, Lloyd's could quickly slide back below 70p. That's why smart investors are taking a balanced view, holding for dividends and moderate growth rather than betting on massive spikes. So what's the final verdict? Is Lloyds Bank a hidden gem or a risky trap? In truth, it might be a bit of both. If you're looking for a fast growth stock, Lloyds probably isn't it. But if you're hunting for steady income, solid fundamentals, and long-term stability, Lloyds shares might just be one of the UK's most undervalued plays in 2025. As we wrap up, here's the quick takeaway. Lloyd's share price up nearly 40%, YY dividend yield around 4.8% risks, motor finance case, and market volatility. Analysts target 95p 1.05. Investor sentiment bullish but cautious. The market's message is clear. Lloyd's is no longer the forgotten stock of the FTSE 100. It's slowly proving that in uncertain times, boring can be beautiful. And sometimes, the safest banks bring the strongest returns. Voice tip. Keep your narration tone steady, confident, and analytical, like a CNBC or Bloomberg segment, with subtle excitement when you mention price jumps or key stats. Use short pauses after figures to let the audience digest information quickly.